Lightning like Steve McQueen, I'm in the fast lane when the light turns green. And I built tough, I ain't nothing but grit, cause I made rugged blood, sweat, and spit. Yeah, like a horse I fly, better push yourself in for a bumpy ride. I like to play hard, but I work harder, and I weather the storm cause I'm built stronger.
What is up, ladies and gentlemen? We are back. We are live. It is the Freight Coach Morning Show, the top morning show in transportation, coming to you live every single weekday, 8:30 a.m. Pacific, 10:30 Central, to break down the realities of this industry. We break down 3 industry headlines every single weekday out here to give you guys some actual insight on how to work in these markets, as opposed to, hey, everything's falling apart, go fuck yourself, which seems like is kind of the narrative that you'll see out there by certain media sources and everything else. And, you know, at the end of the day, they're always responses to be, it's not our job to tell them how to do anything. But that's our job here at the Freight Coach Network. Our job is to provide education and insight on how you guys can all stay profitable in any freight market that's out there, because we give a shit about the 97% of this industry that is small business and they're trying to live out that American dream like I am able to live out every single day right now. Dennis Everett, good morning. He's already out there live on YouTube. Good morning, sir. Bob Hazarati, what's up, brother? Good morning. Scott, the freight sensei, he's here. He's live. Good morning, sir. Hey, before we jump in, as always, my friends over at VHub make this show possible every single weekday for you guys. Asset reallocation, trailers, usage, we all need it. Whether you're a broker or carrier alike, you need access to trailers at some point. Whether you're building a drop trailer pool at your customers' facilities, or you had an issue with your trailer, it's down for a week, but your truck's still running, they give you an opportunity to go out there and make a little bit of money while you're doing it. What do I mean by making a little bit of money? Look at this, you guys. You get paid to move this stuff, all right? Right now, they got some trailers up there in Utah looking to go up into Winnipeg, Manitoba. 1850 USDs coming your way if you move this for them, all right? And that's on top of the revenue that you would book by putting freight in there. So, I mean, look at it this way, you guys. It's like if you book a $5,000 load, obviously this is a hypothetical example. Please don't hold me to this and say this is cheap freight, but book a $5,000 load, get $1,850 in it. That's $6,850 for you on that. That's going to help you offset some fuel costs and everything else that seemingly is not slowing down. They also have them over in Paragould, Arkansas, as well as Glade Spring, Virginia, and those get $1,850. And then your domestic U.S. moves here. Brand new trailers out of San Diego, looking to go up to Spokane, Washington for $400. And then they have some from San Diego going over to Dallas, Texas for $550. Hit up my man, Xavier Campos, vhubapp.com. Xavier Campos is in the audience. He's already here. He's ready for you, as well as my friend Stacy Seen. She'll be out here as well if you want to talk to her. And yeah, I got a very special guest for you guys here today. Whitney Fowler, happy Friday. It's a good day at Eastern Freight Brokerage. Hell yeah, you did. Welcome to the TIA. I love it. I am a massive fan of the TIA. I work with them a lot and doing a lot of their new broker training and stuff like that. So if you sign up for one of those courses there, Whitney, through the TIA, you'll get me a few of those sessions that you're going to see out there. Leroy, good morning, sir. Jeremy Reed, he's in the audience. Good morning. Let's see. I'm going to bring on my guest right now. His name's Josh Kraus. He's been in the audience here recently. He's been shown the love. He's with OTR Leasing, and a company that is also dedicated to keeping the little guy in business and helping them live out their American dream. So, Josh, what's up, man? Thank you for joining me.
Hey, thanks for having me, Chris. Appreciate being here.
No, dude, it's a pleasure. You know, like, seriously, you guys, I'm looking for people who care about the industry, all right? And all he did was reach out. And here we are. That's the beauty of social media. Like, literally everybody I know has been introduced through social media, and I appreciate it. Dude, and I could just tell right away, like, you literally are in love with what you do every day. So, like, what is OTR Leasing? How do you guys work with this?
So we provide just the tractors for owner operators. And generally it's just for the one-off owner. It's for the little guy. So, you know, we do have some relationships with some big carriers. We do buy a lot of trucks. We originate, 80 leases a month. So we do have a pretty big portfolio. We've been around for 10 years. But the main thing for me is, and Chris, you and I talked about this. Nobody cares about the driver anymore. When you hear a FreightWaves article or a Transport Topic article, they're always talking to Penske, or they're talking to Pack Lease, or they're talking to JB Hunt, and nothing's wrong with any of those companies. God knows we need them. But nobody's talking to, one of our members who's got 9 trucks. What does he think is happening in the market? And so what we've realized in kind of onboarding a lot of technology is that with our telematics and with our relationships with our members, we got 1,500 trucks out there. We can actually give a voice to what the little guy is doing, what their fuel economy is, what routes they're running, and try to bring that to light to like combat some of the clickbaitiness that's going on inside of our industry. So
absolutely, man. And we actually, so Josh showed me, he's got something cool on their website. I'm going to pull this up here in a second. I just got to go through my, my morning routine. Todd. Okay. Whitney, I'm looking forward to seeing you in August. Todd Waldron is the king of dad jokes at time, peanut butter and jolly time. Wow. What a line. Speaking of Todd Waldron, he's the CEO over at Q Carriers, you guys. They're hiring right now. All right. They're looking for a business development rep and or a director of sales as well. If you're based in the Minneapolis market and you're looking to align with a very forward-thinking company, I mean, Todd's one of the smartest guys in freight, in my opinion. He's not paying me to say this at all. I truly believe that, even though he makes fun of me with peanut butter and jolly time stuff. But seriously, guys, reach out to him. Reach out to Q Carriers. It's an exciting opportunity. You guys won't want to miss finding out more about that. Pat Green, good morning. Xavier, here we go. Look, reach out to him. He's got trailers for you. Nick Erdman, I appreciate that, brother. Thank you so much for the support and all of you guys' support out there. Are you a part of OTR Capital? Jeremy Reed is asking.
We are not. No, we are complete. We work with OTR Capital. They're actually now called OTR Solutions, but no, we have no relationship. We don't have any. We're unique all into ourselves. Okay. We don't have any relationships with anybody else in the trucking industry. There's no co-ownerships. There's no partnerships. We are on an island.
Ah, man, I got you. Sonny Sharma, good morning. Hey, we're at day 65 of the Freight Coach Tally of there being a truck parking issue as well as a facilities issue in this industry. And as always, you guys, I will stop talking about this when I stop receiving pictures and messages from drivers who are out there actually driving still and showing me all this stuff. And it's like, again, I see both sides of it. I get it, but I also don't understand why we're open about telling somebody they're going to sit for 9 hours and they can't leave and they can't use a bathroom and they can't get food or anything like that. Like it's absolutely ridiculous to me. And again, I'll stop talking about when I stop receiving these messages. Diesel is gold or whatever, precious metals we want to throw out there at $5.72 a gallon. And it's up a lot. I'm getting all this information from AAA because ironically, the government's website's not working. Shocking.
Hey, go figure.
I know you'd think our tax dollars could have a fucking working website, but anyways, conversation for another day. Let me see here. Samantha Bass, good morning. So yeah, I'm going to pull this up right now. So, we talk about this frequently, you guys, on this show about, the benefits of when you're in business and knowing your costs, knowing your operating ratios and everything else and how to stay up there. So I'm going to pop this up on the stream because Josh has this on their company's website right now. And Josh is going to be able to walk you guys through how you can plug and play. Now, you don't have to, Josh, correct me if I'm wrong. Any driver can go on there and use this, right? Like they don't have to be an OTR leasing.
Yeah, 100%. So otrleasing.com, you click on the menu on the top right. It's under the member center called Affordability Calculator. And we've got everything set up here for you. You can plug in your information real quick, just based off of 2021 numbers and current fuel. You can make it whatever you want to make it, whatever your rate is. So we can run through this a little bit slower. There are tabs for what your monthly looks like, what your weekly looks like. There's some estimates that get blown out here for every mile that you run loaded. We're assuming that you're going to run about 18% unloaded deadhead. Your average miles per gallon, and we'll mess with this in a minute to kind of show you what your break even looks like, but shows you your annual gallons of fuel needed at an average price. And I know somebody in your stream is going to tell you what it is right now in Chandler, because typically they do. It's like 601 or 602, right? What you're getting per mile. And this is assuming that you're running in the spot market, which we'll get to in one of the conversations that we've got in one of the topics. Your average rate per mile. Also kind of some assumptions on what your total fixed expenses are. And we can run through this with your truck payment and your trailer payment and your truck insurance, license and registration, ELD, phone, internet. So we plug in the numbers, and anything that isn't grayed out, of course, you can change. If you have a trailer and you know what your trailer payment cost is, you can include that information and it'll change everything. And what we use this for is not only when we're entering into an agreement with a member, but also when they're contemplating changing a carrier, which according to the industry standards is everybody's doing it. You can look at what you're going to earn or what your break even is. So in this environment, if you're going to run 96,000 miles and fuel is 572, and you're going to run that consistently, your top line income is going to be, over 2.5, and your total expenses are going to be 186, and your total net income is 75 grand. And that's pretty on par with what we saw in 2021 for the full year at that mileage range. Now, one of the things that we've been trying to communicate to all of our members, if you can figure out how to increase your average efficiency by 0.5 mile per gallon on an annual basis, watch the $75,000 total net income. That's eight grand that you just added to your bottom line. That's $750 a month, $300 a week that you just added by simply driving a little bit slower.
Yeah.
I know that nobody wants to really be the truck driver in the right-hand lane driving 55 miles an hour. But ladies and gentlemen, if you can make 90 grand instead of 75 grand because you're getting 7 miles per gallon, it's probably worth it. If you can figure out how to run that way, it's beneficial. So this is available. Once again, please hop on our website, use it anytime you want to make it. You don't even have to call us and talk to us. You can just hop on our website. It's a free resource. You don't have to fill out any information. You can just run right to it. It'll also show you your break even on miles. And that gets a little wonky because the math is a little bit weird, but as Matthew Kane says, right, numbers never lie. It's just a math equation that we have out there 100% for you guys to use. And please use it to make better decisions in your route optimization. Stop deadheading 300 miles, right, to go pick up a $3 a mile freight.
No, and that's exactly it. It is just looking at that. It is a small change. And again, like as I speak on frequently, I am not a fan of the government putting a mandate out there that you have to govern your engine at a certain thing. But as a business owner, you have to look at all of the variables that are affecting your revenue stream. Fuel is always going to be one of them. So it's like, if you look at the cost benefit analysis of running at 68 as opposed to 72 miles an hour and see what that can do for you, especially right now. Especially right now, because it doesn't seem, Pat Green says that the EIA was working for me this morning. 567 is what the national average is at. Still an absolutely astronomical thing. David Nelson sat for 6 hours, ran out his clock, and they wouldn't let me park on site, had no food or bathroom options. Folgers in Lacombe, Louisiana.
Shame on them, man.
So there we go. I mean, that's an example right there, you guys. I don't know how much more real it can get for you right there. I don't know how much more real that can get. Jeremy Reed, he says next time use your personal clock to the next safe haven that's out there. Cody Miller, good morning. All right, man, let's get in. Let's get into our first one. For my friends over at DAT, my man Dean Croak, who was on the show here a while ago, he'll be back on here soon enough. He put it out there. It's DAT.com. It's under their blog section. It's insurance costs continue to rise for truckers. Accident rates are on the rise, and so are insurance premiums, it says. According to the ATRI, American Transportation Research Institute, insurance premium cost per mile increased overall by 47% over the last 10 years, from 59 cents to 87 cents a mile. But accidents are not the only factor in the rising insurance premiums. There are also rising medical and litigation costs, nuclear verdicts, catastrophic losses, reinsurance costs, a higher percentage of inexperienced truckload capacity entering the market, and lastly, the economic performance of the industry itself. The later point plays a more significant role than most would have you believe. Just like the trucking industry, the commercial automotive insurance market is cyclical. And right now, we're in what's called a hard market. For the truckload carriers, understanding the difference and what to expect is essential as these cycles affect availability, terms, and price of commercial insurance, and it's part of the property and casualty line of the business. So what's the difference between a soft and hard insurance market, it goes on to say. And that is a soft market, or a buyer's market, is characterized as a stable or even lowering premiums, broader terms of coverage, increased capacity, higher liability limits, easier access to excess layers of liability, and competition among insurance carriers for new businesses. A hard market or a seller's market is characterized by increased premium costs for the insured and so on. So like, dude, like how do you work with bringing this information up to your clients when it comes down to it with insurance and everything else?
So this is great. We're in the middle of this right now. So everybody out there probably has more information than I do, but for us, there's two main things. It's where are you getting your liability from? And then the other stuff is pretty low cost. It's like, $350 a month, $4,000 a year for your, your comp and collision on the asset, and then your OC/AC, and then your non-trucking liability. So those things are almost a non-issue. The problem is that depending on your driving history and your record, you're going to have anywhere between $12,000 to $24,000 a year in insurance. And so that's a big deal. And so what we communicate to our customers is, we've been doing this for a long time. Our members is, hey, they all don't have to come from the same provider. You can shop best rates all over the place. And that was what I was going to communicate here. Depending on your level of negotiation, if you're driving for a carrier, making sure that you're under the carrier's policy for liability is probably in your best interest and is going to minimize your costs. But the other problem here, Chris, that you didn't necessarily get into is that commercial auto insurance is a flipping joke, man. Like they usually offset their 104% claims by investing their money on the other side. Well, I don't know if you know this, but we're no longer in a bull environment. We're in a bear, and the commercial insurance people aren't making money on their investments. And so they're even hurting worse. So which then, of course, where does that come back to? It comes right back to the drivers.
Insurance rising and everything else. And
yeah,
it goes on to kind of close out this article. It goes on because like this is a good article, you guys. And again, research this. I put all the links to all the articles out there in the show notes on my YouTube channel, as the Freight Coach, as well as over on the Coffee with the Freight Coach podcast for the audio only version of this. Do your own research on all these articles. But again, this is well put together because, it closes out by saying, what can carriers do to reduce the cost? The first thing is to code accidents by what caused them and not by describing what happened. Determining the cause can be somewhat subjective and takes an experienced person to reach a solid conclusion. But in doing so, the fleet can address the root cause rather than the symptoms. And this in part explains why severe accidents involving large trucks are getting worse, not better. Yeah. The reason is that the majority of underwriters, loss control, and safety managers are looking in the wrong place for these answers. The second thing to do would be to begin managing the cause of accident risk and not the cost of insurance. Reducing excess coverage and increasing deductible and self-insured retention levels will not sustain insurance premiums if the underlying risk is not addressed. And because 80% of the claims still are caused by 10 to 12% of the accidents that are out there. And knowing that is the start, and it's wild, but that, like, when you see a stat like that, that's not surprising because it's very similar to business. 80% of the revenue is generated by 20% of the people. Right. And stuff like that. And, it's just wild to see. And yeah, man, I think like insurance is one of those things that we pay for the shitty drivers out there. Yeah. At the end of the day, you can have a clean driving record. Like my insurance now is more expensive as a 36-year-old than it was when I was 22. Right. How the fuck is that?
Right. Because a bunch of people that grew up playing Mario Kart decided to go out and drive.
Yeah, that's true. A lot of these gamers, dude, I'm telling you, it's not the same thing.
Hey, there's one other piece. There's one other piece too. And I'm not going to say that it's a great solution, but if you're okay installing a dash cam, if it's not already provided by your carrier, the dash cam can prove that you didn't make the mistake as the driver of the semi-truck. Because what we've seen is typically the semi-truck driver is always at blame unless they have video evidence to the contrary. And so that could help save too on some stuff. Yeah. You may actually get a benefit on your payment if you do have, not only a camera, but telematics, et cetera. So.
Yeah, no, absolutely. I think that outward facing cameras are great for that. And anything to do to help prove that you're not at fault would be key in that. All right. Next article, ttnews.com. Spot market declines accelerates as demand softens. Trucking spot market is experiencing an accelerated decline as pre-pandemic conditions reemerge. The coronavirus, we don't need to get into that. But this has been the spot market shift as a pre-pandemic norms. We are beginning to see steeper decline or correction back to a familiar marketplace. Brent Hutto said he's from truckstop.com. Brent's a really good guy. It's still above normal, still significantly above normal, but it's declined every week. So that's the thing. Rates are not necessarily followed suit because the fuel costs keep going up. And then it goes on to say that Truckstop's data shows that total load availability was hovering around 300 points at the start of the year, and it has reached a peak of 320 during the week ending of March 7th, and load availability started slowly falling from there until it reached 222.73 for the week of June 27th. And it's we're starting to see it correct a little faster than normal. We're not seeing less freight in the overall marketplace. We're just seeing a correction of contract freight as it has been pushed of contract freight that had been pushed into the spot market because it was rejected at the rates that were contracted at. More of the freight is staying in the contracted marketplace. Yep. So essentially, Brent is saying what we've all been talking about on this show specifically is that tender rejections are low. The spot market rates are low because contracted rates are significantly higher. Now, that doesn't say that there's not going to be a rebalancing act. And that's kind of what Dean Croak, Dean's just on fire with me today because now he's in this article as well. Dean goes on to say it's rapidly normalizing, and that's what's throwing people off and creating the headline. We're turning back to normal for freight market behavior and everything else. And then, goes on to say part of the problem, though, is that operating costs have gone up by that much as well. Rates aren't as good as they were last year, but they're still okay. Not everywhere, but, we're not going to see this mass exodus, he says. And I just think that, again, it's like, to me, this was one of the more well-versed articles on how the spot market actually is. I think what we're seeing is what I read from this, and my big takeaway is you have to remove the last 2 years of high prices from it because it's starting to act like a normal market. And my friend Adam Wingfield talks about this stuff all the time is fuel was actually more expensive back in 2008.
Right.
And the rates were lower.
Right. And people still figured it out.
Yeah, exactly. And that's the main thing is like, because again, I would be screaming a very different tune if freight volumes were down. Freight volumes are not down.
Right. And the freight's still there. And like, as I've tried to explain it to people that aren't necessarily involved in this, you have an individual that was making, and I'll just use round numbers, $20 an hour in 2019. And then in 2020 and 2021, they made $40 an hour. And now in 2022, they're making $30 an hour. It's still better than what 2019 was, but going backwards always sucks. And that's kind of like the guy that was running the spot market. He was killing it for a minute. She was killing it. They were killing it.
Yeah.
And now it's cooled off a little bit.
Yeah. Josh also has a degree in economics as well, guys. Just throwing that out there. So he knows how to read numbers. Oh, was I not supposed to say that?
No, it's fine. But I think you give it too much benefit. I just read stuff like this, and then I synthesize my own comments about it, and I just say the same thing twice in my own words.
Yeah, absolutely. Dean Croak goes on to say load post volumes are a measure of the spot market demand have been decreasing, but that's not any big surprise given how high contracts have been. So if we talk about load post volumes, they're about 10% lower than this time in 2018, but about 32% lower than last year. So again, they're still in line at 10% of 2018, because I think that was right before the last like market shift that kind of happened. So for me, that just it's just more of a normalization is what we're getting into. Load volumes, the panic buying, all of that stuff has since subsided. I'm not saying that this isn't an issue or anything like that. I want it to be abundantly clear, but that's why a guy like Josh is on this show today to show you how to run your costs, how to be able to navigate through this. And then, rest assured, you guys, again, there's a lot of weight thrown on national averages that are out there, and the national average is not the story on a lane by lane basis throughout North America. And I just want people to be aware of that. I'm not saying that there aren't some shitty, cheap loads that are out there on the market right now. I know there are because all my driver friends show me that stuff and it's pitiful, but that's not everywhere. All right. And I don't want anybody to lose hope because it might be the area that they're looking in. Yeah. And when you expand that out and everything else and you find it, I know that there are some lanes right now in certain states that are running for like $4 a mile. All right. And it's just identifying them. And that's the thing is you can't run big city to big city. You can't run Houston to Kansas City all the time because that's what everybody's going to run. Yeah. All right. Find those secondary cities that are out there in that market, the less desirables. yes, it might be a 40-mile deadhead over, but it also might pay 40 cents more a mile overall in the loaded miles. These are all hypothetical examples, but these are very real possibilities if you're expanding your reach out there. So, let me see here. Again, that was a well-written article that was out there as the spot market decline accelerates as demand softens, ttnews.com. And then Jeremy Reed, this was he said something about the insurance here a while back, but it was make sure to tell folks that they can make sure they get the most uninsured, underinsured policy that he carries, $300K, and it's cheap. Dude, we just got like 5 minutes left. I don't know if we get into this last article because
this last article was like a 5-hour conversation.
I know, and I've already had this conversation a few times, but I want you to talk to these owner operators that are out there right now. What is some practical advice? Like if I'm in this situation where, you know what, I don't know my numbers, I don't know where I'm at. And again, I talk about knowing your numbers a lot, you guys, but there's no playbook to this stuff. And people are in situations, but what is one, like, where would somebody start? How could somebody start like getting this stuff in order? Is it direct shippers? Is it, how would you advise them? Because I'm sure you have this conversation frequently.
Yeah, it's hard because everybody's so different. And also there's certain levels of ego that are involved that,
of course,
a bearded guy wearing a Royals hat. What do you know about my life? So
he's talking about himself.
That's me. So it gets a little bit difficult, but the first place to always start is, hey, what's your expectation, man? Where are you expecting to drive? What are you expected to earn? We start those conversations there. We dig a little bit deeper about, hey, how are you prepared for some level of a mechanical failure or some catastrophic event that happens that's going to cause you to miss a load or miss a week of driving? Can you absorb that? What does that look like? We believe that the number one reason that truck drivers fail is, first of all, equipment failure. Second of all is, like behind the scenes business. And then third is some level of a health condition, either with the driver themselves or in their family, because insurance is rough. So there are services out there that are provided to help you manage the tax side and the business book side. I would recommend looking into some of those. We can talk offline. You can DM me and I can give you some recommendations there. But the main thing is, you just because you can drive a truck for 100,000 miles a year doesn't necessarily mean that you can run a business. And if you can drive a truck for 100,000 miles a year, you can still get paid pretty well. But it may look different than the guy that's sitting next to you at the Flying J in Oklahoma City. So the comparison monster, as I like to say in my personal life, comparison is the loss of joy. So trying to duplicate what other people are doing may not be the best success for you. Mm-hmm. So you've got to know, individual 00 out there, you've got to know what you're doing. You've got to know where you're going. And if you need to break it down by a run to run basis, what you're doing today versus what you're doing tomorrow, what you're doing 4 days from now, then start there, because you got your ELD, you know what your fuel economy is. You've got your receipts on your phone for your credit card. You know what you're paying for fuel. And once again, this isn't one of those situations where we're saying stop eating at the Subway at Flying J to make more money. This is like, hey, don't, as Chris said, don't be so laser focused on driving from San Diego to Irving, Texas, that you miss the opportunity to drive from, I don't know, somewhere just a little bit south of San Diego to Houston and make a little bit more money. Right. Don't be so laser focused that you just want to drive from Houston to Kansas City that you're going to miss out on going to Memphis or something like that. Yeah. You got to be able to process what it looks like. And if you use our site, great. If you just use your calculator, great. If you use a pad of paper and you've got, it hit the green screen right here. Got me the whole thing. Anyway, if you use a pad of paper and pencil, please, like it's really grassroots. And we can help the best that we can. We've got people that can help. And as I told Chris, we just want the owner op to succeed. We want the little guy to win, because the better off that they are, the better off everybody is.
I agree,
That's
man.
not a real direct answer, Chris. I apologize, but it's as good as I can come up with.
No, man. It's that's the thing is sometimes you have to look at alternative solutions, and I'm all about niche markets, niche regions, and everything else that run
Mhm.
like that. But sometimes instead of being laser focused on one lane only, if you expand it out by a 50-mile or 75-mile radius, you might see a
Yeah.
big difference out there.
Yeah.
David Nelson, I think if this isn't AB5 is an industry problem, man. I've talked about this a few times on my show. I think AB5 is an absolute fucking atrocity to small business in general.
Mm.
Like, it's not just truck drivers. And yes, truck drivers are going to be affected by this. And that's what we talk about here on this show. But it's an atrocity. It's an absolute assault on small business, in my opinion. It just brings up the term collective punishment. Like, I get that there were some people out there taking advantage of some others, but you can't punish the many. All right. Like, I just don't fucking agree with that at all. Again, as I say all the time, we're about freedom over everything on this show. So that's it for today, guys. We'll be back on Monday as always. Kyle Provost, what's up, brother? Xavier, he says you're a great guest, Josh. Yeah,
Thank
Josh
you.
will be back, you guys. Again, we're out here putting together a network. The Freight Coach Network, as I said, is not my network. It's our network. It's about keeping us all in business through any freight market that's out here. It's not just me sitting up here saying, do this, do that. I know that there are people out there who are a lot smarter than me in a lot of other areas that can help people stay profitable. The 97%, my family who are truck drivers. I come from a family of truck drivers. I give a shit about you guys. And we're going to fight tooth and nail until we collectively as an industry make this industry better that's out here. Again, that's it for today. Q Carriers is hiring. Hit up Todd Waldron on LinkedIn. If you guys are looking, if you're in Minneapolis, business development rep, director of sales, hit up Todd Waldron, Q Carriers on LinkedIn, DM him, let him know the Freight Care sent you so I can rub it into his face when I see him here in a couple of weeks. But other than that, you guys, that's it. All the links and everything will be uploaded onto the show notes on my YouTube channel. If you saw value in this, you guys share the show. All right. That's all I can ask of you at the end of the day is to share the show, because if you see value in this, your network's going to see value in this. And this is how this is going to continue to grow, as a collective of like-minded individuals who are putting their foot down to absolutely work together in every way possible that we can to make and move this industry forward. I appreciate you guys.